So now that the recording is in progress and it's 11 o'clock New York, Toronto time, welcome everyone to our last seminar, webinar of the fall semester. And we're very pleased to have Chester to speak to us about dark crypto. And Bryan and and Tom are also here, and they will be taking the tough questions in the chat from what I hear. Chester has asked that you hold your voice questions until 15 and 30-minute mark. And with that, Chester, the floor is all yours. Thank you very much. And thank you all for joining us.
I want to thank the organizers for inviting us to present our paper, and look forward to the feedback from the audience. And as mentioned, Tom and Bryan are also available to help answer questions through the chat. And the paper is joint with them, and also Ariel, Zetlin-Jones. So the paper is basically about different approaches to intermediation in crypto trading. Like other markets that we're more familiar with, like the equity markets and the options markets, a lot of trading occurs through exchanges, but also, like in the equity market, there's also off-exchange. There's off-exchange trading. Off-exchange trading occurs through brokers, and they route to wholesalers. This is actually an important feature in the equity markets, and we'll see it's also important and can lead to better execution in crypto trading. Potentially the brokers provide intermediation services that are valuable to customers. And one other feature of the crypto trading as well is there's the potential for decentralized trading. Peer-to-peer, there can be peer-to-peer crypto trades without any central intermediary, either a broker or either a broker or an exchange. Smart contracts can be used to automate trades. There can be private keys. Investors can have their own wallets. So custody issues are going to be quite different in crypto than it would be in the traditional equity or option markets. And part of the point of our paper is not only to highlight the role of brokers in the overall process, and brokers as an intermediary, but also to highlight aspects of the custody process, and more broadly, what's different about the nature of intermediation in crypto trading. So much of our paper is entitled Dark Crypto. That's because there's not much. There's really arguably no transparency in the trading process in crypto. There are no reporting rules, for example, for trades, unlike in the equity and options markets that most of us are much more familiar with. And in fact, even on the blockchain, there's a lot of discussion about blockchain and the role of blockchain in in transforming ownership, but individual trades don't show up on the blockchain either. Brokers, one of the key themes in our paper is that the brokers potentially provide superior prices. The trades of many investors in crypto go through brokers. These markets are, to some extent, there's segmentation, similar to equity and the options markets, and there's spread competition as well, competition in part between the exchanges and wholesalers through whom the brokers typically trade. There are no. Meanwhile, I should note that unlike in the equity and options markets, there are no best execution requirements for crypto trading, but also that the benchmarking can be especially difficult in crypto trading because of the lack of central clearing and the lack of interchangeability. So if your assets are custodied at one particular exchange, that's not equivalent to their being fully accessible at other exchanges. And so there's sort of frictions potentially in the crypto market that are not present in the more traditional markets where there's a more integrated clearing process. At some point, in fact, going back in history, at some point in the options markets, there was not uniform clearing either. But one of the important innovations in the options markets historically was the use of the Option Clearing Corporation to provide clearing of contracts such that if a contract was executed on one exchange, you could simply sell it off in another exchange, which led to kind of much greater degree of competition. So, our paper is related to a number of different literatures, best execution literature for equity, which Tom and I, in fact, have been contributors to. Literatures involving trade transparency across various markets, and literatures specific to crypto and some of the transaction cost issues that arise without a central clearing. One of the our contributions will include what is the nature of best execution for crypto, that highlighting that dark over-the-counter crypto trades don't in fact always occur on the blockchain, and to also provide a method to estimate implied fees across exchanges. So we contribute to these various literatures. We have a number of different types of data. We have data from a broker about their routing practices in detail. We also have TARDIS data that provides us very good detailed microscopic data on quotes and trades, including off-exchange transactions, and we marry the two data sets to get together, I think, in some very useful ways. I should also note that on the wholesaler side, our data set includes $550 billion of trades over a 5-year period from a broker who plays an important role in these markets, and the brokers is trading through many wholesalers. The wholesalers, I want to be clear, are anonymous in our data. So while on the slide I identify several wholesalers, these are simply suggestive. These are some of the prominent wholesalers. So this is some illustrative. So to illustrate to you a little bit more about the nature of our data, we have data on a whole variety of coins. If you look at the picture, a couple of takeaways from this. So first, the first main spike occurs early in 2021. That occurs at the time of the GameStop event. I think another important time point in these markets was actually in July of 2021, when Binance reduced its leverage limits. The really high spike actually occurs somewhat in between GameStop and the Binance action. I should also point out a couple of other aspects of what the graph is illustrating. It's illustrating, in fact, that it's more just about the nature of our data, that we have 4 years of data, and that we have a whole series of coins in our data set. Perhaps the two most significant, two most substantial coins in our data set are arguably Bitcoin and Doge. And one of the things you can see from this plot, which spans basically from 2022 and 2023, is that volume changes a lot, even day to day. I should also note that the order a lot of people think, oh, retail, they're just buying in these markets, but that's not the case. That's not the case. Retail both buys and sells. And here we have the order flow imbalances. The left panel focuses upon Bitcoin, the right panel on Ethereum, and it is also illustrating that the retail order flow is not perfectly balanced over the month, and that sometimes you get a lot of retail activity that's concentrated on the one side or the other side of the market. Among the issue, so orders are routed to wholesalers by the brokers by brokers based upon the stream quotations. The types of issues that we want to take up is allocation to wholesalers competitive. Our preliminary answer to that will be yes. What is the price impact of these dark orders? For most trades, in fact, it's very small. Do customers obtain good prices? Our data suggests, and I'll include some graphical illustrations that better prices can emerge through the broker than the exchange. Some of that seems to be due to the fixed costs associated with trading through exchanges. Um, trade trades are allocated based upon the stream quotations. Um, and maybe the most striking aspect is that wholesalers who offer better average prices obtain more order flow. And I'll present a regression result. Um, um, so in particular, we ran a regression. We broke out the data based upon the day, the coin, and which wholesaler. Those became the unit of observation. And what we find is that the tighter with a tighter spread, the share of activity is substantially larger, at a 1% significance level. As control variables, we use things like order size. For example, the larger orders, not surprisingly, pay more. So in looking at our wholesalers, our trades are completely dark. I want to reemphasize there were no trading requirements at all. There were no reporting requirements at all, and this is completely different than, of course, what we know about the options and the equity markets, where at least post trade there's considerable price reporting. Um, in terms of price impact, um, um, we look at a distribution of price impacts over a variety of time intervals, and for the most part, the initial impacts are negligible, but also the impacts, excuse me, the impacts are relatively uh, symmetric. If you look at the 50th percentile quantile, there's a slight positive bias that's suggesting that the median trade is consistent with a bit of momentum. But broadly, I would say that half of the trade prices go up and half of the trade prices go down. Okay. So we excuse me. So first of all, I focus on the right hand portion. of the slide, we construct the NBBO. We construct an NBBO based upon data from various exchanges. Um, um, Now, I want to be clear that there's no. This is different than, let's say, in the equity markets, or for that matter, the options markets. There's no regulatory based construction of this. We though use the data we have from TARDIS to construct this basically using the microsecond type data that we have. So we're looking basically at the envelope of the asks across exchanges and the envelope of the bids to construct the national best bid and offer. So that's what the right-hand portion of the slide illustrates. If we look at the left-hand portion of the slide, you notice in the upper plot the black dots. Those are the broker trades. And if you look at the lower portion, the triangles again are the broker trades. And what these plots are illustrating, this is for a particular couple of our slice in the data. And what these illustrate is that the brokers seem to provide marginal improvements. I mean, the dots tend to be below the blue line above on the above panel, and the triangles tend to be actually well above the red line in the lower panel. Maybe this is a good point for we're probably about 15 minutes in, I would guess. So maybe this is a good point for questions. Okay.
I have a question, Chester.
Yeah, go ahead.
Do you have an explanation for why there seems to be more price improvement on the bid side?
That's a good question. Do I have an explanation? I don't have an explanation, but that's probably something we should think a bit more about. In fact, that wasn't something, until I was describing it to you, I hadn't really fully internalized that, but it seemed to me pretty clear. When I was looking at the picture as I was describing it to you, it seemed to me pretty clear that there seemed to be some difference there. But that's
Okay.
that's a good question. Thank you.
Thanks.
Okay. Okay. Any
Yeah.
other questions, or should I go on?
Probably just go on for now, and then we'll.
Yeah, sure.
Thank you.
If you think there's and Katja, if you think there's a natural point to interrupt, don't hesitate. Okay.
Sure, will do. Thank you.
Okay. So we also looked at savings. Uh, um, we looked at the potential savings from the brokers against various exchanges, and here our focus is really on exchanges that are at least sort of reasonably regulated. In particular, we had in mind exchanges in the U.S. and the EU, and it seems that the savings from the brokers do come down over time. But even toward the end of our sample, we're seeing savings for this particular. Our data is from one broker. I should reemphasize that. But from this one broker, it seems that the savings are on the order of $1 million to $2 million daily. On a more aggregated basis, in terms of the annual savings of the brokers, in the next table we present some statistics about that. I should note, by the way, that while these markets do not have routing to the best bidder offer, the SEC, in fact, itself is reconsidering regulation NMS, or at least portions of regulation NMS, particularly the order protection rule, which has played such an important role in the equity markets over the last 2 decades. Indeed, by coincidence, the SEC has a roundtable on that subject, competing with my talk right now, which they're conducting in Austin. So the SEC is actively considering possible changes in the equity space. In the crypto space, there is no analogy to the order protection rule. And so the exchanges are not obligated to pay deference to better prices at other exchanges, or for that matter, off exchange. But the brokers do well. The broker we study, I should say, does seem to provide some degree of price improvement. Here, what we're depicting are the annual savings of the broker in millions of dollars. And I should comment a bit on our benchmark. I mean, one benchmark we use is a randomly selected exchange. Another would be the second best exchange. And again, I should comment on a point that I raised earlier in my presentation, namely that there are real frictions associated with switching exchanges and with the holdings. And this does really strike me as a bit reminiscent of the early days of option trading, where if you did, let's say you did a transaction on the SIBO, for example, you bought an option on the SIBO, basically you needed to sell it on the SIBO, as compared to how it's worked in recent decades, where the option clearing corporation clearing process allows you to trade on any exchange, which obviously creates a greater degree of potential competition. So an interesting aspect of the exchanges is that the exchanges charge trading fees, and the trading fees, there were both the trading fees, they're a little bit opaque, it's fair to say. On the one hand, the take fees, they're often around 0.4 of a cent, with some variation, but they are very much opaque. What we tried to do is we tried to focus on, for each exchange, on small retail trades, and focus on those fees. But I should note that the fees are volume tiered, and how the competition between these works has sort of varied a bit over time. For example, the question of which exchange has the best fee adjusted pricing has varied a bit, and I'll present more data with respect to that shortly. It's a bit reminiscent of a market that I'm very familiar, that I'm perhaps more familiar with than the crypto market, which is the market for airline tickets, and my own traveling. And clearly, what I've observed there over many years is that that the rewards from these frequent flyer programs, they're a little bit opaque. They often have volume tiers. If the exchange has a volume tier, obviously it provides a lot of incentive to hit the volume tier. But there's also issues then of how that impacts the nature of competition across exchanges. I think more broadly, I think this discussion raises issues a bit about who is cheapest. Is one exchange cheap? Is one exchange cheaper than another uniformly? For example, is it all or nothing? If you look at the graph on the left, uh, in some of the earlier time periods, I guess in particular 2022, it basically was all or nothing. So you've got a flip in terms of who seemed to be nominally cheapest. But that may be a bit misleading, because I think, in fact, there are trade-offs with respect to liquidity, and you see that in the volumes um, as well. That there are some trade-offs, and sometimes what these types of pictures can show can be kind of misleading. In particular, we have this time period, I would call it the gold part of the picture, the tan part of the picture, in which the FTX US looked better. Well, when did it look better? It looked better right before it collapsed. But that surely was a misleading um, description. It was based upon the stated fees rather than the effective or marginal fees, and the cost, the nature of the custody um, and risk costs associated with trading on FTX, which I'll say a little bit more about shortly. But then in the latter part of this sample here, so basically roughly the period 2023, you've got more serious competition than between Gemini and Kraken. One other point to note, which will be a fact that comes up a bit later, is that the over-the-counter market makers are paying the brokers. You can think of this as a little bit analogous to payment for order flow. Maybe not exactly the same thing, but it's certainly the analogy probably bears worth noting. And the other aspect that I should also note is that there seemed to be a change in some of the stated fee structures around May 4th, 2022, where it jumped up from 25 to 35 basis points. And I'll just note that the fees do seem to dominate costs in the crypto trading. I want to come back to this issue of this jump. Will kind of show up nicely in one of our later figures. Actually, will show up nicely in the next panel. So if you look, this is a plot of transaction costs for using data from different wholesalers for Bitcoin, and on the left side we have the total costs. The total costs, they jump if you look at that May 2022 date. They jump. There seems to be this discontinuous shift in the left panel, but if you look at the net costs, the figure looks very continuous at that point. So again, here's a plot. Here's a graphical illustration with some of the well-known exchanges, with a well-known exchange, Binance, and at least suggestive wholesalers. I think one of the issues is competition between them. And related to that is the issue of who holds the inventory. Does, for example, the exchange, do they have custody? Do they need to have custody of the entire inventory? If you trade through a broker who has the custody, potentially it might be the market maker who's retaining custody. The transfers among the relevant parties, let's say, they don't occur at a trade level, but they're periodic. But it does raise the issue of if you if you as an individual, or for that matter, if you're a wholesaler, um, with respect to trades on exchange, there needs to be some degree of trust, because of the possibility, of the risks associated, with the trading process. Exchanges charge higher fees than the brokers. So potentially the broker trades look better than some sort of fee adjusted NBBO. As I noted earlier, the fees do depend upon usage. Now what we did was we collected the fees um off the Wayback Machine. They don't seem to change much. That's a little bit like the airlines too. The airlines in the frequent flyer programs, their structures don't move around so much. They do move around from time to time. But again, I want to emphasize that no one gets 100% of the volume, but it does raise questions about what are the benefits. And I'll to pursue this airline analogy, I'll cite two examples from my experiences with airlines. One example is I had the opportunity this week to buy an airline ticket for next week, and I clearly decided not to choose on price. I decided to fly on JetBlue rather than Spirit. Um, um, and similarly, I've been boycotting, probably atypically, I'm sure, among our audience. I've been boycotting Southwest for at least the last 7 years. And sometimes even at the cost of taking a change of planes, rather than a direct flight. Now you might wonder, well, why is that? Why is that the case? Well, frankly, it's the case because I'm, as probably almost all of you know, I'm very tall, and somewhat big, and frankly, the seats. The seats on Spirit and Southwest don't fit me. Um, um, so I choose accordingly. And there's a range of services being provided, by the different parties. So not everybody, you would not expect everybody would route in the same way. And I think that's there's a simple way to kind of explain some of the heterogeneity in decisions. So here, to pursue this a little bit further, here's an illustration, of the best bid and ask what the statutory fees. And if you look at this graph, the green curve, that's Coinbase, so it seems, so what I'll just note is that Coinbase doesn't have all the, despite the fact, despite what the picture shows, Coinbase doesn't have all the volume. So Katya, this might be again an appropriate. This might be, we're perhaps past the 11:30 point, so maybe again we should pause for questions.
Yes. Any questions? I actually have one regarding the fees, because I understand the make-take fees, but what about like transferring to the exchange versus transferring to the broker, withdrawing to a self-custody wallet, and how do those differ? Because in a sense, I'm thinking, and then also kind of a connected question to the range of assets that I can trade, because I agree with you that it's when I transfer my assets I mean, it's different, right? To trade on a crypto exchange, I actually have to transfer assets in custody to the custody of that exchange. So I can't just pick and choose as I do in equity markets. So the structure, and I think it might be worth just mentioning in general, is a little bit different. But then if I want to transfer my money to Binance, I have access to quite a large range of assets. Do I have the same access via the broker? So guys, my question is, do they compete on other dimensions that are sort of not so typical for equity markets or option markets?
Okay, so let me answer that in part, but only in limited part. So, um, yeah, if you have resources at a firm, you would have access to the range of things available through that firm, whether it be a broker or an exchange. I think that's pretty clear from a perspective. So, for example, an entity that was trading across multiple coins, there might be some comparative advantage. I think you're raising an interesting point about comparative advantage for the multi-product um, for the multi-product firm. Um, um, as to the details of the specific fees, um, um, for putting resources in the wallets and the like, were still at a preliminary point with respect to some of those issues, but we certainly do view those as important substitute. It may be my co-authors may want to say more either now or maybe at the in the post presentation Q&A. But I think my knowledge of the differences in those fees sort of otherwise is a bit limited right now. But I do think you raise an important point with respect to the multi-product, the multi-product aspect, and that a player who can a big player who's got a business that spans across that would be an advantage if some of the players don't span if some of the players don't span across. Okay, other questions.
There's a question in the chat, but yeah, I'm just the multi assets. I'm just curious because as a Canadian, I'm so well protected. I don't have access to Binance, so I'm like wondering the multi asset seems to have some value to me that no, I cannot access, which is why I kind of it came to mind. But there is a question in the chat that I think you can I can read it or you can read it, and if you
Yeah.
could answer it, that would be great.
Okay. Yeah. So I don't see. I don't.
Sorry, the question is, or maybe Andre wants to address it in voice.
Okay. Sure.
Yeah, can you hear me?
Yeah. Go
Yes.
ahead.
Yeah. So my question, I was wondering if there's any opportunity to use the launch of BlackRock's Bitcoin ETF as a kind of natural experiment, to kind of think about how the greater involvement of institutional investors in the crypto markets might be affecting fees and prices, and whether or not that will improve transparency over time and make it less dark.
So it sounds like it may be it may be an interesting natural experiment. We obviously haven't explored that at this point, but it sounds like it may be an interesting natural experiment. Um, um,
We should probably continue and
thank
then we can get to
Okay.
questions later.
Thanks for
Thanks.
thanks for the suggestion. Okay. So here's another picture. In this case, where we're comparing the spreads, and in particular, we look at an example in which OKEC and Binance US have the same fee, and what one finds in this is that the NBBO keeps flipping. unlike the prior picture. So it is illustrating that there potentially can be competition, even that we can kind of pick up. So in the next picture, it illustrates that the MBBO is the envelope, and it's easier to see in this particular picture. It's easier to see who's on top. Um, 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 so there's the broad question of how do we measure trading costs without central clearing? A lower spread in exchange could reflect the number of possibilities: lower trading costs, perhaps some sort of lock-in and search costs, could reflect differences between broker and exchange services, could reflect alternative fees. So it raises the question also, can we identify the implied fees? Investors are trading off the spread with observable fees and also unobservable components like trust, ease of usage, the volume tiers that I spoke of from the airline context, etc. So what we did on this front is we looked at the percent of the time different exchanges were at the top of the book, and then we did a calculation to equate those times from the different exchanges under the assumption that they should in quotes potentially be at the top of the book, equal proportions of the time, and that I'll sort of show you illustrations of that in a moment. And in particular, how often is the set that provides the MBO relative to the average or 1 over n. Now we're working on another calculation to do this based upon the actual volumes, but we haven't completed that. So this figure illustrates the potential consistency across exchanges in terms of who's cheap and expensive. It does seem, in looking at the figure, that the exchanges that there's a fair amount of consistency across. And that's suggesting, if there's consistency in who's cheap and expensive, it's suggesting that there's real differences perhaps in service and custody and the like. That's really about the only way one can explain the consistency. At the same time, outliers are kind of interesting, and so I want to turn to that. So here we highlighted a few key events. Maybe the most important event is the first of the dashed lines. That corresponds to the FTX bankruptcy. You see that the implied fee shoots up as FTX goes bankrupt. People are desperate to trade on FTX to get their money out. For example, in the case of Bitcoin. We show a couple of other events. We show the suit of the SEC against Binance, and we show a hedge fund suing Gemini. That was important in these markets as well. Now, drilling down a little bit further, we focus again on the bankruptcy. So this is from early November of 2022. This was the broader period where FTX was going under, and in particular, FTX went under. The bankruptcy occurred on the 11th. And I'll just note that the fees get higher on the ask side as people are anxious to get their Bitcoin out of FTX, and so not surprisingly, there's a big impact at that point. I should note yet the behavior on the bid side looks pretty well perfect. So the action's all on the side of trying to pull resources basically out of FTX before it's too late, so to speak. So final issue. Final issue I want to just say a little bit about is I'll note that, of course, off-exchange crypto trading has minimal transparency, but there is also trading which we're working on at sort of the earliest stages, trying to understand, involving on-chain transfers. These might represent additional volume, but keep in mind also that the on-exchange transfers, there might be lots of transfers that are occurring within the exchange or through the brokers that aren't going through the on-chain, are not going through the on-chain process because they're offset, basically. I should also note that the on-chain doesn't involve recording of prices, it just involves recording of ownership. And in developing this, developing the picture that follows, we're going to use some data from Arkham. We're going to examine the transfers to and from some large wholesaler wallets, and this illustrates the inflows and outflows. This illustrates some preliminary data on inflows and outflows, and I think at this point I'd like to conclude and just to summarize a bit. I'll note that we're studying. We have proprietary data from a broker. We look at the crypto trades, $550 billion worth of the crypto trades through a broker over an extended period. We find that the broker delivers potentially superior prices. At the same and that there's competition between various market makers. And at the same time, the costs of trading are dominated to some extent by fixed fees, and so it's important to get a handle on fees. We develop, in fact, a methodology to try to get a preliminary handle, at least on the fixed fees. At the same time, I'll note that the crypto trading does not involve the type of transparency that we're familiar with in the equity and options markets. In particular, people talk a lot about the blockchain, but the trading occurs not necessarily by going through the blockchain. The trades through the exchange, and even with the wholesalers, they don't necessarily go through the blockchain, except when the exchanges or the wholesalers want to adjust their holdings on the blockchain. In fact, there's no reporting rules for trades, and in fact, there are important issues in the background involving how should retail customers access crypto, and in fact, in the past, there's even been issues about whether retail customers should be allowed to access crypto. I think a key issue in terms of understanding the nature of transaction costs is also the issues involving central clearing and custody. The trades represent the exchange trades represent liabilities, and so the spreads reflect transaction costs and some of the custody kinds of issues. And I think there are also some interesting issues with respect to the nature of best execution and what would a duty associated with best execution for crypto look like in light of some of these types of issues. So maybe at this point we can just sort of open it up for questions.
Oh, thank you very much. Just questions? Do you have an opinion on how retail should access crypto since you put it on a slide? I'm just curious to
I'm sorry.
hear what you. So you
I'm
have the
sorry.
regulatory question, how should retail customers access crypto? And I was just wondering if you had an opinion on what
Well, I mean,
the
to some
appropriate
degree,
access is.
yeah. Well, I think to some degree, um, um, I think. Well, my opinion is partially anchored on the fact that I think what our study points to is that intermediation services can be valuable, and so folks not ought not to just assume that just because you go through an intermediary, that's necessarily going to increase your net costs. But it does mean, that some of the traditional ways we think about best execution, they're somewhat narrow. They would be somewhat narrow in this context, I think.
Maybe not an answer, but just a question for the audience. I'd love to hear anyone's thoughts. I think
Mhm.
one thing that maybe struck us in this project is there are a lot of protections for investors at the SEC. Traditionally, retail investors trade securities. If we consider a bunch of cryptocurrencies to be commodities, I think that's a kind of new problem that a bunch of retail investors are trading commodities when historically, I don't think retail investors did that much commodity trading. And so I think there's just maybe, tangential to our paper, there's a broad tension here between we have a ton of regulatory structure for securities trading. We don't have a ton of retail investor protections for commodities trading. I think that's an interesting topic.
Yeah. And to elaborate on that just slightly, the SEC, I think the evolution of the SEC in terms of the current regime seems to be moving at least somewhat in that type in the direction of not mandating the historic SEC rulebook for crypto. But that's obviously still at a preliminary stage in terms of the SEC's thinking.
Chester, I was just wondering, what are your thoughts on um, what I perceive as sort of like a sort of regulatory capture by like really key players in the crypto market, who basically taken over the SEC's view on crypto and how that is evolving. Like, how do you see that interacting with some of the findings that you've presented here?
Well, I think at this point I sort of have an open mind um, um, about that. That's not to be necessarily favorable fully, but I thought over the last number of years, the SEC just provided a blockade in this space without facilitating the development of these markets. So I think it's a difficult. I think these are challenging issues, and I think it's important to have a healthy debate. Now, whether there's going to be a debate, this still remains to be seen. And indeed, there's also some ambiguity. From a legal perspective, there's some ambiguity in terms of the whole statutory framework. And as probably most of us realize, the Congress has not been probably over the last decade or so. Congress has not been a terribly functional organization, and so clarification of some of the legal boundaries has really not progressed very much. Although I think that on the crypto issues, at least there's been a little bit more of a debate, at least in the Congress, I think, than maybe on some other issues.
Eric?
Yeah, I have a question sort of in the same spirit as the previous question. So there's some tail risk that's unique to crypto, and I'm curious how you think about it. So the Congress and the Genius Act used the phrase cryptographically secured. And if you read the text of the Genius Act, it acts as if cryptographically secured is a kind of perfect security. But if you hold cryptocurrency, if you hold it natively and someone steals your password, they steal your crypto. If you hold crypto through an exchange or through some kind of brokerage account and someone steals your password or compromises the exchange's security, there's a tail risk there. There's the tail risk associated with other large scale thefts or hacks of either the blockchain itself or of exchanges. And it's a whole suite of tail risks that's present in crypto in a way that is distinct from stocks and commodities. I'm curious how you think about all that, let alone the kind of more traditional tail risk of prices going to zero, and that you see that. And
well, yeah. So Eric, I first thought that's where you were going on the last point. On the last point, because there's obviously some broader debate in the background. Is crypto a meaningful asset? Is crypto, are the crypto assets meaningful assets? Should they have a positive price and the like? And that's what I would think of as the maybe sort of the type of economic tail risk. Although obviously the theft issues and loss of password. These are important issues. Now, I would think those issues maybe could be handled in ways that are different than a total ban on crypto trading. For example, but these are difficult issues that will be helpful if the regulators provided some clarity about. And sometimes I think the SEC has been a little bit slow. I think of the issues, for example, that were litigated a couple of years ago involving the ETFs, and what the ETFs was based upon the spot and the future versus the futures, and at some point the court just sort of weighed in and sort of said that the SEC's perspective was just kind of plain arbitrary on that. So so I do think there's certainly a lot of open issues in the space, but I'm not sure. Perhaps I'm partially being asked these issues, perhaps because long ago I served as chief economist at the SEC. But I don't know that our paper. I'm not sure that our paper provides so much with respect to the specifics of these broader and very important points, of course.
And the connection is, in a sense, there's this implicit duty of a broker in for example, stocks, where I want Charles Schwab to give me good execution, and that gets a lot of attention in market microstructure. But what I really want is for them not to lose my money. There's like a basic level of safety and security that we often take for granted. That's the relationship to what you're.
Fair enough. So this reminds me a little bit more of the role of SIPC, for example, right? I mean, this is partially what SIPC does, right? With the broker, the SIPC provides protection, kind of a little bit like the FDIC. It provides protection against the broker going out going out of business.
And that's very customer friendly, right? To have that kind of protection.
No, absolutely. Well. So, but and that could be done in ways that seem to me to be separate from whether there is or isn't a best execution requirement, whether there is or isn't an NBBO. I mean, keep in mind that part of what our paper does, of course, is we try to measure. We try to we make at least a preliminary stab at measurement of what would an NBBO be like, and how to think about what the broker is doing relative to the NBBO. So that's so we're arguably more focused on the traditional microstructure measures.
I was just
But
going to say, Eric, I think we learned exactly the lesson you've just suggested here is all the traditional micro stuff here relies on things like central clearing. If you don't have central clearing, how do you determine the best market for a security? Um, and so, Katya, I think, maybe also related, we don't have solutions for how regulators should act because in part, the problems in crypto are unique to crypto. You have this new problem where you don't have central clearing. So then how do you define what best execution would even look like? How do you determine the best market for security when every trading security always has that underlying custody risk?
Yeah, I
and
would
you
just
know,
add it's a
and
bit
like
like, sorry, I would just add it's a bit like commodities in the sense of we talk about the price of oil or the price of natural gas, but like it's very specific to the specific oil or the specific location of the natural gas. And so a Bitcoin on Binance or a Bitcoin at Coinbase, they're kind of all related to Bitcoin, but they're quite different things, as you point out, in terms of all the sort of real risks in terms of like security or just how you move them or somebody freezing your assets or know your customer. And I think like part of the challenge for regulation is that it's not all living inside the US in the way that sort of equities would be.
I want to ask a more philosophical question around should we even be thinking about crypto markets in terms of traditional microstructure? Do we need an entirely new framework to understand these markets?
well, I guess I would respond to that by saying maybe partially yes, and our paper is an attempt to at least partially do that. So we're in the types of issues that we're engaged in. They're slightly different than would arise in traditional microstructure. They're a little bit broader issues about the nature of the nature of intermediation and how brokers provide certain types of services that wouldn't be so relevant, maybe arguably not so relevant in the options and equity markets, for example. They were pointing to kind of some of the issues involving custody and clearing. Now, you might say, well, these are traditional microstructure kinds of issues, but in a form, um, um, they're much less well defined, I think, than they would be in the equity and options markets, or at least yet the regulatory bodies haven't defined them so well.
I like
If
your
you teach
point,
a,
Brian, about the commodities actually
yeah,
quite a lot and how it's different types of oil. So I'm wondering is on the like for Bitcoin, I mean, there is still the Bitcoin that you can just buy on the Bitcoin blockchain directly, and then of course there is the exchanges. Have you compared also to like decentralized finance or just the centralized exchanges? Or I mean, it's not. I actually think the traditional microstructure works. It's just we may need to redefine the players and some of the measures potentially in the interpretation. But other than that, there are.
I think there is,
What I was describing toward the very end of my talk was that we're starting to look at some of the flows associated with the decentralized exchange process. Obviously, the nature of the data then would be different, including that one wouldn't have prices, and that one could batch things together to a fair degree. But
and you can't just buy a Bitcoin on the blockchain. You got to find somebody to sell it to you. So that's a sense in which like basic, microstructure or just economics is kind of all interesting. Part of the advantage of teaching classes like this is all these sort of cool issues about sort of settlement and custody, which come across as a bit dry because they're kind of settled if you're talking about equities. Here, they're kind of first order importance. So like
I
it's
meant
way
the
easier
DeFi
to
exchanges.
motivate the students to say, like this is really interesting because like, yeah, it can go missing. So,
I meant the Uniswap or
yeah.
SushiSwap or whatever
Yeah, yes. Same. Yeah, like
the
different ways.
different.
Yeah. I mean, I think the other interesting feature about like retail is like the arrival of exchanges basically put these sort of you are a trader in front of retails in the sense they designed the user interface to look like a little terminal from, what you used to see on only on an equities exchange. And so the interesting experiment is these sort of retail traders are trading side by side with institutional traders in a way that like didn't used to happen in equity because the markets had grown up as so intermediated.
One more question, if I may, for the costs and particularly for Ethereum. If we go to Coinbase and like teaching comment reminded me that my students say, oh, they're promising, this huge exchange rates or sorry, huge interest rates if I just keep my money in there. And sometimes it's just because of the staking rewards for ETH. And so I'm wondering if that factors in at all into considerations, like how to, and I guess that collects to the different microstructures. It's not really different, but there are other aspects in crypto that we don't think about it.
If they're offering a high interest rate, if you leave your assets at a particular exchange, for example, that seems to me to be compensation for credit. That seems to me to be compensation for credit risk and points to the custody and points to these custody issues. You clearly would not expect to see that, for example, in equity or options markets.
One thing I'll add is, the staking rewards that I think our broker offers, the broker who shared data with us, I think they're pretty much in line with industry standards, like if you want to transfer to your own wallet, I think the fees there are pretty in line with the other exchanges. I think maybe the biggest difference, going back to your original question, is they only offer 16 coins. So maybe some people want more coins than that. I don't know. I think maybe another suspected belief we have might be that just consumers don't do a lot of price shopping. And either it's low information or because, as Eric pointed out, there's big custody questions of when you're picking one institution or another. So I think there's maybe just not around. There are big differences in fees, and I think they might be across the board. That one place could be universally cheaper on every checklist, and there's just not enough shopping around. Or there's
Or
information
maybe
you
this
custody
would
bill,
trust the broker to keep my money safe and
right?
where I go.
Yeah.
Any other questions? Well, thank you very much. Thank you everyone for coming. Thank you, Chester, Tom, Bryan, for presenting. Thank you for your questions. Have a great holiday break, everyone, and we'll see you in the new term.
Right. Thanks for the opportunity to present and for the feedback.
It's trying to stop the recording.